In part one of the retirement planning model video series, I went over the assumptions. I want to reiterate that I'm not a certified financial planner. I am a decision analyst that believes in making decisions considering uncertainty is important. Before getting into the model, I'd like to review just a couple of the basic inputs. The model assumes initially that it has $100,000 in an after-tax account that we can draw upon if needed to, but only up to a maximum percent each year. And also that this money is invested 60% in stocks and 40% in bonds. We will be able to specify a minimum and maximum stock percentage over time. It is important to understand how the stock and bond appreciation is calculated. I used historical data from 2004 to 2017 and calculated the returns shown here. The stocks grow at 7.6% on average, and the bonds basically are flat. However, the bonds have a much higher dividend rate of 2.8% versus stocks at only 1.57%. Another key assumption is other income that you might have prior to full retirement. Now I've assumed here $60,000. We also assume Social Security of $42,000 for the husband and $18,000 for the wife when they reach age 66. So let's go over to the model. The model's changed a little bit as I worked it, and I must admit it didn't turn out with results I fully expected, but I'd like to go through it with you anyway. So in this dashboard, we've established a simulation. So in this particular simulation, look at different iterations of the simulation. So this is iteration 2, and let me just put in another extreme here. This is kind of an averaged kind of number. Let me put in an 85, and you'll see that it radically changes. Let's look at the rest of the dashboard. What we see is this green line here represents our desired living expense, and the red line represents what we're actually getting. Down here is the shortfall from the desired. We start off with paying $5,000 too short our living expenses, and it isn't until 2038 that we get back to even, and then we have another big shortfall, which I believe is a result of a poor stock market, and then we finally get back here to over here. Coming down here and looking at the probabilistic results, we find out in 2032, which is when my other income stops, I'm actually only achieving my desired income about 15% of the time. The rest of the time, I'm short with an average of 56,000 right in here, when I want to have about 79, so on average I'm about $3,000 short, I guess. That graph could have been done better. Over here, it's showing my total assets and the P90 mean and the P10. And this simulation 2 is kind of a moderate in the middle sort of simulation. And my money to my heirs or to charity is about $1.1 million. As I worked the model, I came up with different graphics trying to have a better understanding. So one of them was the NPV of the shortfall at 7%, and the other being the portfolio value after 15 years. This was my initial portfolio value, and this is what I have in year 15. You see, there's a very little probability that I'm actually going to be below my initial portfolio after 15 years. Okay, so let's say that I'm looking at this deterministically, and I say, gee, this big downturn here from the stock markets really bothers me. I'm very risk adverse. So maybe what I need to do is I need to change my allocation of stocks and bonds. Right now, it looks like I'm getting up to close to 80%. What if I reduced that to 60% and said that was my maximum stocks? So let's come up here to 60%. And let's look at that. So here, we haven't really helped ourselves too much. It's still about 5,000 short, and I still have a pretty good trough here in this 2040 time frame. Remember, this is one simulation. Maybe we shouldn't look at one simulation. Maybe we should look at some other simulations. Why don't we look at this simulation 85, which is actually a really bad result. And let me show you that one. So here, remember, this is our current simulation here, and you can see it's down below the mean. And now we're only achieving our living expense in 2032, maybe 5% of the time. And we don't have a trough, but we're just always low, always low. So that didn't really help us too much. Let's put that back to our 80%. Here we are again, back to our base case, simulation 2, and 60,000 of living expenses desired. Can we help ourselves if we were to reduce our living expenses to $55,000? In this particular simulation, we eliminate all of our shortfall. And in 2032, we have no shortfall. It's a vertical line here. And our money to heirs has actually gone up to 1.4. I think we had 1.1 before. So that looks pretty good. If I looked at that bad case of 85 now, even in that case, I don't have a shortfall. What's showing here is that our desired living expenses, 55,000, correspond to our minimum living expenses. That's why we don't see two lines here. So if we can live with 55,000 rather than 60,000, we're able to contribute some money to our after-tax account with our other income. And it's just a short few years that we have to take money out of our after-tax account when the Social Security stops. So if this 55,000, let me come back here to simulation 2. What if would that allow me to retire 2 years earlier? Perhaps I could retire in 2031. That might be nice. And I still have no shortfall. I'm taking more money out of my after-tax account, and you can see it dips down here, but I'm still doing all right. Let's go a couple more years. 2029. Now I'm starting to see a shortfall in my living expenses. In fact, it's way too much. I've got a shortfall here of $70,000. So that doesn't work. I can't retire in 2029. Maybe I could do it in 2030. Of course, this is deterministic too. We really probably should be looking at the probabilistic results. So in 2032, I'm achieving my desired income more than 70% of the time. So 2030 probably works. Let's go back to the 2029. I'm getting much too focused on the deterministic, which is a bad thing. I need to be looking at the probabilistic results. And in here, it's about a 45% chance. So I think if I was running this retirement model, I think 2030 looks like a reasonable retirement age, retirement year, if I can live with 55,000 in income rather than 60. Let's stop here. I think you get the idea that there's a lot of flexibility in this model. If you should desire to have a copy of this model, I'd be happy to send it to you. Just send it to my email address, brian@theputz.com. Thank you for watching.